SBI Life Smart Elite Plan. Will this ULIP help you create long-term wealth? What kind of risk or return this particular ULIP policy has in place? Let us analyze and evaluate. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions. First, let us understand the key features of this policy so that we will be able to get more clarity to evaluate this policy. SBI Life Smart Elite is a unit-linked insurance plan. What is unit-linked insurance plan? When we pay a premium, a portion of that is taken for giving you life cover, then there are other multiple charges. Balance investable money will be invested in stock market and money market based units. So that means this policy is a market linked policy. This policy goes through market risk. There can be volatility, ups and downs. This is not a traditional conventional plan where you have 100% safety. No, here you take a risk. There are multiple options to pay premium, and the premium allocation charge is there for the first 5 years, and after that there is no premium allocation charges. As an investor, you can pick and choose from various fund options given by this policy. For life cover, again, gold and platinum options are given to you. You can also switch from one fund option to other fund option. You have riders like accidental death benefits and permanently disabled benefits. All those things you have, and these riders come with additional premium charges. Last but not the least, tax benefit, Section 80C benefits. Whatever the premium you pay under this particular plan is eligible for Section 80C benefits. Right. Over and above the tax benefits, there are two major benefits in any insurance policy, which is basically an investment cum insurance policy. There are two benefits to it. One is death benefit, and the second is maturity benefit. Let us see them one by one. First, let us take death benefit. In case of an unfortunate death of the policy holder, then what money is settled to the nominee as death claim? If the policyholder has chosen gold option, then the insurance company calculates three values. Out of that, whichever is higher is given to the nominee as the death claim. First one, fund value as on the date of claim. This is the first calculation company does. Second calculation, sum assured in the policy. That is the second value. Third one is 105% of the total premiums paid. 105% of the total premiums paid. Out of these three things, whichever is higher is given to the nominee as the death claim. If the policyholder has chosen platinum option, then in that case, the company calculates two values, out of which whichever is higher is given to the nominee as death benefit. First one is fund value. Second one is 105% of the total premium paid. Out of these two, whichever is given to the nominee as the death benefit, right? So in the platinum option, there is one additional benefit, means fund value as on date of the claim plus a sum assured, that is given in addition to the other option, like 105% of the total premiums paid. Out of these two values, whichever is higher, that will be paid to the nominee in case of death of the policy holder. I told you there are different fund options available to investors to choose from. So there are totally 8 fund options, starting from equity elite fund to corporate bond fund. You have funds which can invest 100% in stock market. You also have fund options which will invest 100% in non-stock market, that is money market based investments. So you can, from the risk profile point of view, you can take higher risk investment option also, or you can choose to invest in low risk investment or medium risk investment option also. You can pick and choose. You can invest in any combination in these 8 funds. You need not necessarily limit yourself to only one particular fund option. You can direct your premiums to go in 2-3 funds in these options. Whichever is best can be chosen. Depends upon your risk appetite. You can choose like how much to allocate in equity, how much to allocate in money market. Depends upon your time frame of investments, so short term, medium term, or long term. Accordingly, you can pick and choose the fund options. Also, based on the market outlook, you can pick and choose the fund options. All these asset allocation, you will be able to do it if you know how to manage this on your own. Okay, like we have looked at the death benefits and also the fund options available. Before going and looking at the maturity benefit, let us see what is the premium allocation charge. You know, there are multiple charges. We will see them one by one. Premium allocation charge is an entry charge. Whenever you pay the premium, this is charged. This goes up to 3% maximum. This is basically an entry charge. Policy administration charge is also kind of an entry charge when you take this policy, right? These two like charges are not admissible or justifiable charges in my humble opinion, because these charges are not there for mutual funds. However, fund management charge is an admissible, justifiable charge. They are charging up to 1.25%, which is reasonable to manage our funds in stock market and money market. Like these charges is something like we have to pay to them. It is definitely admissible charge. Discontinuance charge, like after paying premium for 1 or 2 years, if you want to discontinue paying the premium, then again there are charges involved in it. Then for partial withdrawal, there are charges. Switching, there are charges. Premium redirection, there are charges. Premium redirection means you are paying premium in one fund. From the next premium onwards, you want to redirect it to a different fund. Again, for that, there are charges. Number 8, mortality charges. To give you life cover, they are charging. Again, this mortality charge is definitely admissible, justifiable charges. Accidental benefit charge, medical expenses on revival, these are all rider-based additional charges. These are all optional. But first 8 are mandatory. Out of these 8, 2 charges, right, which is basically fund management charges and mortality charges, are justifiable charges. Rest of these 6 charges are not at all admissible, justifiable. These charges are not there in mutual funds because SEBI is a very strict regulator. They have given specific percentage what needs to be charged as an expense ratio. There are clear rules and regulations. That kind of clear rules and regulations should evolve in insurance products also over a period of time. As of now, the charges are on the much higher side. Before ever, like coming to a conclusion, let us take an illustration and find out what kind of return this policy can give. I have taken this illustration from SBI Life's official website. An investor is paying a premium of 5 lakhs and getting a life cover of 35 lakhs, and he is paying premium for 10 years. 5 lakhs is paying for 10 years. Then from 11th year onwards, he is waiting for 10 years. That means on 20th year, the policy will mature. On maturity, what is the maturity value he is getting? He has paid 5 lakhs for 10 years. So totally he has paid 50 lakhs in the first 10 years. Then in the next 10 years, he is waiting. On maturity, how much he is getting? This illustration given by SBI Life assumes 4% a scenario and 8% another scenario. 4%, 8% are gross return, pre-expenses return. With this return, what kind of return it is giving? Let us see. 50 lakhs invested and we are waiting for another 10 years. It is giving us 70 lakhs in 4% situation. In a worst case scenario, it can give you 70 lakhs. In a best case scenario of 8% gross return, it can give you 1.28 crores, right? So it looks like I have paid 50 lakhs, I am getting between 70 lakhs to 1.28 crores. Does it look like a good investment policy for you? Just wait a minute and I'll show you what is the internal rate of return this policy is giving you, both in worst case scenario and in best case scenario. So this is where you go. Internal rate of return in a worst case scenario works out only to 2.26% return. In a best case scenario, it works out to 6.20% return. Right. So that way, if we look at it, even after taking a risk and investing in stock market, even after taking a lot of time and waiting for 20 years, this policy gives you 6.20% or less. Definitely, this is very disappointing. because the 6.20 percentage is comparable to your bank FD. The 6.20 is less than post office time deposit returns. This will not help you beat inflation. This is not a risk premium return, not a good risk adjusted return. Even even government backed insurance schemes like PPF, RBI bonds is actually outbeating SBI Life Smart Allied best case scenario return. PPF is giving you 7.10. RBI bond is giving you 7.15% return. These are all government backed assured guaranteed return. Whereas 6.20% from SBI Life Smart Allied is not assured or guaranteed return. It is market linked. It can go up and down. Instead of investing in PPF or RBI bonds, if you choose to invest in ELSS mutual funds. ELSS mutual funds are investing in stock market, so it can go up and down. Volatility is definitely there. Same volatility is there in the ULIP of SBI Life Smart Allied, right? So I'm taking the similar risk products and creating a combination of term insurance plus ELSS. So from the premium 5 lakhs which you are paying for 10 years, take some money and pay premium for term insurance to get 1 crore cover. Balance money you invest in mutual fund, ELSS or diversified equity funds. On maturity, like how much value it works out to. Like at the end of 20th year, it works out to 2.94 crores. Whereas even in a best case scenario, ELSS mutual fund, SBI Life Smart Allied has given you 1.28 crores only. Whereas ELSS mutual fund, I have assumed the average return of 12%. It works out to 2.94 crores, which is definitely a good appreciation, good long-term return, good risk premium return. After adjusting the term insurance premium, the net return works out to 11.69% compared to the IRR of 2.26 or 6.20 in SBI Life. Mutual fund ELSS gives you much higher return. You take the same risk, but you get much higher. So do you have to buy this SBI Life Smart Allied unit linked insurance plan? You must be guessing the answer, because it has got huge charges. Out of 8 charges, only 2 is justifiable, 6 are not justifiable charges. Because of these charges, the overall return comes down. Then this is not a good long-term return. This will not help you beat inflation. These are all the major reasons why you have to tick and no for this particular policy. If you are a very conservative investor, then you can go for a combination of term insurance plan and PPF. Definitely the overall maturity value will be better than SBI Life Smart. Then if you are comfortable taking risk, market ups and downs, volatility, then in that case, go for term insurance plan plus ELSS mutual fund combination. Term insurance plan plus ELSS mutual fund combination with the same amount of risk you take in ULIP gives you additional returns. It gives you inflation beating returns. It gives you risk premium returns. That way, I would strongly suggest you to go for SBI Life Smart Allied. Please avoid. You can go for either combination of term insurance plan plus PPF or term insurance plan plus ELSS mutual fund. We have done an in-depth research on this particular article. The detailed review analysis is given in our website for your perusal. You can go through that. I have given the link below this video in the description. You can click the link and read the detailed analysis of this particular policy. If you have any follow-up questions with reference to this particular investment or any other investment option, feel free to book a free appointment with our certified financial planners. Our certified financial planners can clarify all your questions related to personal finance. It is completely a complimentary consultation. Again, the link for this is also given below this video. Also, we regularly organize insightful investment webinars with good investment experts. They talk about wealth creation strategies, long-term investment strategies, good techniques to follow. All those things are available. It is again completely free for our YouTube channel subscribers. So you can click the link in the description. You can leave your name and email ID. You will be getting our invite for the next webinar. Hope you like this video. I'll meet you with yet another useful video soon. Bye.